This is the section on accounting for treasury stock. And the first one transaction that we'll look at is purchase of treasury stock. Now remember, treasury stock is stock shares that the company has issued, and you're buying them back from whoever bought them, whoever holds them, at whatever the fair market price is at the time that you buy them back. So, let's say we have a company that has paid-in capital common stock. It has $5 par value common stock that's been issued. There's 100,000 shares issued and outstanding. Okay, so let's say on February 1st, 2012, we'll call this company Mead Company. They decide to buy back some of these shares of stock because they think lots of different reasons why. You can read in your text all the reasons why. I'm just going to focus on the mechanics, the journal entries to doing this. So let's say on February 1st, 2012, Mead buys back its stock. They're going to buy 4,000 shares at $8 a share. Okay, so that's the market value on that day. So when they buy it, they're going to debit treasury stock for 4,000 times their cost of $8, which is 32,000, and they'll credit cash for 32,000. Now, this $8 a share is the cost, and this is what we're going to be paying attention to when they turn around and sell these all or some of the treasury stock. So I do want to make a point that treasury stock is a contra account. So in the stockholders' equity section, it's listed, you'll have your paid-in capital, retained earnings, and then you'll have less treasury stock. And so, because it has a debit balance. And the other stockholders' equity accounts have a credit balance. So if we were going to do a partial balance sheet for Mead Inc., we would have in our stockholders' equity section the paid-in capital, which is the common stock, as well as the if we'd had any excess paid-in capital, that would also be listed for 500. Retained earnings, 200,000. Total paid-in capital and retained earnings is 700,000. You then subtract the treasury stock for the amount that you paid for it. So 32,000 is subtracted, and so your net stockholders' equity is 668. So the 500 doesn't change. That's what it was before you bought back the treasury stock. The treasury stock gets subtracted down below. Okay, the next issue that we're going to look at is selling the treasury stock. Now you can sell it above or below cost, meaning more than $8, which is what you paid, or less than $8. So let's look at the first scenario where we sell it for more than $8. Let's say on July 1st, Mead sells 1,000 shares of treasury stock for $10. Okay, now they bought 4,000, so they're just selling 1,000 of them. They're still going to have 3,000 left. Alright, so the journal entry is 1,000 times $10 a share. So that's 10,000. Now the credit to treasury stock is going to be based on the cost times the 1,000 that they're selling. So we will credit treasury stock for the $1,000 times $8, which is $8,000. Now the question is, what do you call that 2,000? They've had a gain on their stock, but because they're dealing in their own stock, they can't recognize it as a gain. So what it's recorded at is paid in capital on treasury stock. I'm just going to put TS, treasury stock. Okay? And so now the balance in that account is $2,000. And if we were going to do a statement, a balance sheet, that paid in capital would be coming up under this section, paid in capital. You would list common stock, and you'd also list paid in capital on treasury stock in that same section. And then you would subtract still whatever the remaining treasury stock balance is, which if we bought it for 32 and we just credited it for 8, then we would have a remainder of 24,000 in that account. Okay, the next scenario is we're going to sell treasury stock below our cost. So we're going to sell 800 shares at $7 a share. Let's say this is on October 1st. So we would debit cash for 800 times $7, 5,600, and we're basically having a loss of $1 a share because we paid $8 and we're only selling it for $7. But again, instead of recognizing a loss, we run it through the treasury stock paid in capital account. So we will debit paid in capital from treasury stock for the $1 a share, 800 times $1, or $800. And we will credit treasury stock at our cost, which was 800 times $8 a share. So again, this is our cost for the amount that we sold. We bought 4,000, we've sold 1,000 at $10, and now we've sold 800 at $7. Now I want to make a point. The only reason that we could debit paid in capital from treasury stock is that we had previously credited paid in capital from treasury stock. So if we were to do a T account, paid in capital treasury stock, we can debit this up to $2,000, and then we have to take it out of retained earnings, the remainder, if there is any. So let's do an example showing that. So before we do that, I just want to show the T account. So we bought it, we sold it at a gain, so we have 2,000, and now we just debited for 800. So our balance in this account is 1,200. Okay? So now let's say that on December 1st, we're going to sell the remaining 2,200 shares at $7 a share. So we're going to debit cash for 2,200 times $7, which is 15,400. Now, we've sold this at a loss, okay, because we paid 8. So we're going to debit paid in capital on the treasury stock for 1,200. That's the most I can debit it for because that's the balance that I've got in there. And after I post this, it'll bring this account down to a zero balance. And so I'm going to skip a line here. Our treasury stock is going to be credited for 2,200 times what we paid for it, $8.17. So the difference between our debits and credits is $1,000. So that's our total loss on this was 2,200 because we had we bought it at 8 and sold it at 7. So we lost $1 per share. But we could only take a loss of 1,200 out of the paid-in capital. The rest of it is going to come out of retained earnings. So the thing that will trip you up on this is if you forget about the fact that if you don't have a credit balance in paid-in capital, you can't debit anything. You can only debit paid-in capital treasury for the amount of the credit. And so you might try and debit paid-in capital for 2,200, and it would be incorrect.